Are you curious how your student loan debt affects your ability to qualify for a mortgage? We'll take a quick listen on today's Finance Friday and I'll tell you all about it. We all know that a lot of college graduates these days are graduating with a lot of student loan debt, and in some cases it can prevent and impact your ability to qualify for a mortgage. But it's important that you know how your student loans and how your student loan payments specifically impact each of the various loan programs, and essentially make sure you work with a good lender who understands these guidelines. Well, I'm here to walk you through that, and so I'm going to cover the main loan programs and how your student loan payments affect your ability to qualify for a mortgage. When using an FHA loan and you have an income-based payment, essentially FHA does not allow that. So we factor in 1% of your balance to calculate as far as a monthly payment. So if you owe $10,000, simply 1% of that is $100 a month. Also, if your payments are in deferment or forbearance, which a lot of student loans are because of COVID, we also have to factor in 1%. FHA will also take fully amortized monthly loan payments. VA loan program allows us to use income-based or variable payments that are reported to the credit bureau, even if it's reported at a $0 payment. They'll also take a fully amortized payment, but if the loan is currently in deferred or forbearance, how they calculate it is they essentially take 5% of the loan balance that you have and divide it by 12. So essentially, kind of already done the math. So if you owe $10,000, essentially your monthly payment is going to be about $41.66 per month. The USDA loan program allows us to use the income-based payments or non-amortized payments that we talked about, or 0.5% of the balance, whichever one is greater. Also, if your student loans are in deferment or forbearance, they'll allow us to use 0.5% of the balance as well. Again, fully amortized payments are accepted on USDA loans. So on a conventional loan, we have two sections. One's called Fannie Mae and Freddie Mac. They look at student loan payments differently. So Fannie Mae allows us to use the income-based payment all the way down to $0 per month, if that's reported on your credit report. If your student loans are in deferment or forbearance, we have to factor in 1% of the balance. So again, $10,000, 1% per month, and that essentially is $100 a month. So if we're doing a Freddie Mac conventional loan and you're on an income-based payment, we're essentially allowed to use that as long as it's reported to the credit report. Now, if it's reporting a $0 payment, Freddie Mac says that we have to use 0.5% of your loan balance. Also, if your payments are in deferred or forbearance, we have to use 0.5% of your loan balance as far as your monthly payment to qualify you for your mortgage. So we've gone over how the student loan payments are impacted by the various loan programs and how they affect your ability to qualify for mortgage. But it's important you work with somebody who has a lot of experience, and I've helped a lot of college graduates achieve the dream of home ownership. So give me a call. I'm here to help. 615-482-1655, or click on my link and have a happy Finance Friday. See you guys.